Hello everyone, it's Professor Reiko. We're continuing on here with our inventory chapter. So this video's got a few terms in it, and then we'll do one little example at the end. All right, so we're still just kind of, still almost kind of an introductory phase of this chapter, still defining things and things like that. One thing to think about is, as far as inventory goes, is who actually records inventory in their books, and has to do a lot of times when control over it is in question. Okay, so control determines which company should include the item in inventory, and control usually means that legal title has passed, with a few exceptions here. All right, so goods in transit, that means they're being shipped. Okay, so let's say we purchased it, but we have not received it yet. Okay, so there's some terms you'll see: free on board. FOB stands for free on board. So free on board shipping point versus free on board destination. Okay, shipping point means that the title passes once the items are delivered to the whoever's the common carrier. Okay, so it's free to the shipping point, and then it becomes our inventory. Okay, free on board destination means that title does not pass until we receive it as the purchasing company in this example. Consignment goods, I think in your revenue recognition chapter, when you talk about the principal-agent relationship, this would have come up as well. But a consignor ships goods to the consignee, who acts as an agent for the consignor. All right, so consignment goods remain the property of the consignor, all right, until they're sold. Okay, so there's, I think in the revenue recognition chapter, there might be an example where they walk through that. But so just a few more terms to remember. So a lot of this, when you see these terms and stuff like this, including down here with the product cost and period cost below, you should be thinking multiple choice questions. A lot of these can pull up in a multiple choice question. All right. So more cost including inventory. So product cost. All right. So direct costs that are directly connected with bringing the goods to the location and getting them in a ready condition. So any freight charges to ship them, direct cost of acquisition, labor cost, and processing the goods, that all is going to be added into the inventory number. Okay. Period costs are costs that are indirectly related to the acquisition or production of the goods, and they are generally not included in inventory. All right, purchase discounts. This is another item to consider here. So purchase discounts are just decreasing the amount paid for inventory if paid within a specified time period. Meaning we could purchase something. So let's just look at this example. When you see these terms, okay, that means you get a 2% discount if the payment's made with 10 days, with the net being due within 30 days. All right, so what this does, this encourages people to pay quickly. So if we're selling inventory, why would we do allow people to take a discount? Well, it might be something where we really prefer to have the cash quickly, and then we're willing to give up 2% of the sale price, or of the money coming in order to have cash quickly, as opposed to there being a long delay, right? Especially if you start a small business and you're working terms like this. I mean, cash is king in a small business for sure, and so you want to make sure you got cash on hand. All right, so there's two different ways to account for it: gross versus net. So the gross method, the companies record purchases. All right, so this is basically, I should write this over here. This is for periodic. Okay, when we're going to do this gross versus net, okay, with the purchases, all right, because they're going to record purchases at the gross amount and recognize a purchase discount when it's taken. Most companies use this approach. On the net side, they're going to record the purchases at the net amount. If they fail to use the discount, they recognize a purchase discount lost, or it could possibly be interest expense for that amount. A lot of people prefer to use the gross method because they don't want to disclose how much discounts they've lost. All right, so let's look at this example right here, and we'll walk through it real quick, side by side. All right, so we got a company, so I'll just put, we'll just do gross on this side and net on this side. All right, so we purchased $50,000 worth of inventory, 2% discount in 10 days, net due in 30. Okay, so since we're doing it as the periodic method, we call it, remember, we don't debit inventory, we debit purchases. These are definitely on account because we haven't paid for it yet. All right, so purchases 50 on the gross side, and accounts payable 50. All right, on the net side, All right, same accounts, but now we're taking the 2%. We're going to go and apply the 2%. So 2% on 50 is 1,000. So this will be at 49,000. All right, so we're already recording a net, meaning we're assuming we're going to take this discount. All right, so it says we pay 30,000 within the discount period. So we get to take a discount on 30,000 of it. All right, so we're paying off 30,000. So this has to come off at 30. We skip a space here. We have cash. Well, actually, I don't necessarily need to do that. And then we're going to have a discount that we're taking. So we'll call this purchase discount. All right, so 2% on the 30 is 600, which means we're going to pay the difference. So we took the discount, $600, paid $29.4. Over here, we're still taking the discount, but we've already accounted for the discount in the 49,000 number, so we don't need to record a discount here because it's all been taken at net. All right, we're still paying the same amount. And then at the end, we pay the rest, not taking a discount. So over here, it'll be 20. So if you look on this side, the accounts payable balance is now 0. Okay, we've paid a total of $49,400 out, the sum of those two numbers right there, because we took this $600 discount. All right, on this side, all right, we're still closing out our accounts payable, but now the remaining balance is $19,600 because remember we took the discount on the front, so accounts payable is now 0, just like on the gross side. All right, skip a space here. We're still paying cash, but now we're paying $20,000 because remember we're not taking the discount. All right, and so here we have to record these purchase discount lost for the difference of $400. All right, so once again, we still paid $49.4 over here, which is the same we paid right here. Okay, so we paid the same amount. It's just we counted for it a little bit differently by netting it on the front end. Okay, so some books don't get too much into this. The KESA book has a little example, so your teacher may just kind of gloss over this and focus on other things in the chapter, and that's fine. But just be aware of it, the difference between these two. So that you can understand that if you get a multiple choice, or even if you get a little small problem on the test, depending how your teacher asks problems on the test, that way you can handle this. All right, so we're going to switch gears next time. We're going to get into the inventory cost flow methods, which is all of our FIFO, LIFO, average cost. And so we'll see some bigger, longer problems when we get to that. So tune in next time for that. Hope you're enjoying the videos. Please share these with your friends. Hopefully it will help them as well, especially come test time. And please subscribe to the channel. It does help me out. Thank you.